Good morning. It's Monday, December 16th, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary, also my final economic and market commentary for 2024. I will be back to you again after the new year. Of course, if there are any major developments between now and then, I will do another commentary. You can follow me intra-week or intra-commentary if there is items of interest on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. The presentation you are seeing and hearing has been developed by me. It is designed to be used by individual investors and financial advisors alike, but both are expected to make their own investment decisions. Nothing in this presentation is investment advice, tax advice, no recommendations for the purchase or sale of any securities. The opinions expressed herein are my views and mine alone. They may differ from CFIA's parent, affiliates, or other portfolio managers here at the firm. Well, you all know we've had a heck of a year, up 28.5% on the S&P through Friday. That's after declining 0.6% last week, largely on higher interest rates. We're up to 4.4% on the 10-year U.S. Treasury, even though the Fed started cutting rates in September and is widely expected to cut rates another 25 basis points this week. The market is not buying the Fed's proposition that inflation is on a path to a sustained 2% core PCE number. In the market, through things like break-evens and just trading bonds lower, making yields higher. Fixed income last week down 1.4% on the aggregate bond index. And look at the 20-plus year Treasury index, down 4.4%. Now, if stocks had declined 4.5% last week, it would be much, much bigger news. But for whatever reason, even though the Treasury market's bigger than the stock market, it's just not focused on as much. But big decline and higher interest rates across the board ahead of an expected Fed rate cut this week. Let's take a look at some of the economic data from last week. National Federation of Independent Business. This is an index that surveys small business owners and tracks their optimism or pessimism. It rose from 93.7 to 101.7 in November on the heels of the election. It was the largest monthly gain on record in the history of the series. Why? Well, small businesses felt better about the economy and their prospects for doing business based on the outcome of the 2024 presidential and congressional elections. CPI and PPI also came out for November last week. The CPI was in line with expectations that are above where they should be for a Fed that's aggressively cutting rates, as it has been since September. The CPI gained 0.3%, right in line with expectations, 2.7% on a year-over-year basis. Remember, the Fed's target for inflation is 2%, as measured by core PCE. But core CPI, a different measure, up 0.3, fourth straight month of 0.3. 3.3% year over year, well above the Fed's 2% target. Then you moved on to initial claims for unemployment, rose from 225 to 242, well above the estimate. Not concerned yet, still some follow-on effects from wildfires out in California, displacing about 20,000 people. We'll give that a couple of weeks to settle back down. Moving on to PPI, Producer Price Index. This is where the trouble really starts to come for the Fed, because producer prices ultimately end up as consumer prices. Producer Price Index was up 0.4% in November, more than double the consensus estimate of economists. After gaining 0.3% in October, the year-over-year gain there is 3. The estimate was 2.6. That's a huge miss. Core PPI, which excludes food and energy, up 0.2, following a 0.3 the prior month, and 3.4 year over year, again, well ahead of the Fed's 2% core PCE. And if you really look at the graph and go over to the right, the downward trend is broken. I mean, we had that initial downward trend after the reopening and the spike in prices as we struggled to reopen the economy after the colossal mistake of the global economic shutdown. And now you can see trending significantly higher There's a lot of work to be done on this inflation front, yet we do expect Fed will cut 25 basis points on the discount rate, or Fed funds and discount rate later this week. Import and export prices. Import prices up 0.1%. Backing out petroleum was up 0.2%. Export prices unchanged in November and up 0.8% on a year-over-year basis. So that's that. That's last week's economic data. And since this is the last report for me for the year, I wanted to give you a little bit of my thoughts on what's likely to happen in the portfolios in 2025. My first prediction is that 2025, in terms of total return to investors, will not be as good as 2023 and 2024 were. Now, that's not that bold of a prediction, because if you think about it and you look, I mean, these were two fantastic years. Just the simple laws of math suggest you can't compound at these high rates forever and ever. The S&P 500, as you can see on the chart here, up 70% from the trough in late 2022. Earnings growth has driven that, justifiable, right? Earnings growth in big cap tech especially, has been significant. The future expectations for artificial intelligence and 5G continue to drive productivity gains and profits in the foreseeable future. This helps with margins. Then we got into the election in the first part of November, and the country took a major turn towards a more pro-growth, pro-employment political philosophy. The Tax Cut and Jobs Act of 2017, most of the components were expected to expire at the end of 25 and 26. These were very pro-growth components, the biggest since the Tax Reform Act of 1986. Now we know, given the makeup of the Congress, that those will not only be extended, but in many cases be expanded, perhaps even a further cut in the corporate tax rate. The jobs and labor market, despite that little blip in weekly claims last week, remains very strong, which means the consumer is strong, and that's what drives the U.S. economy. But just because the fundamentals of the economy and business are good doesn't mean that you're going to get great returns. This is the difficult part of portfolio management. And the best example I can give is back in late 1999. This feels like where we are today, although I would say that the sort of overvaluation of 1999 was more significant than the overvaluation of today. 10 years from 1999 to 2009, we actually had a negative return. We had the lost decade for equities. Now, if you had done things in between, buy dips, rebalance, good chance you had a positive return. But just looking at the S&P 500, we call it the lost decade. It was on the beginning, it was the overvaluation of the dot-com bubble era, and at the end, it was the culmination of the global financial crisis. So here we are today. We've got the risk-free yield in the 10-year U.S. Treasury at 4.37%. That's the green line. So for no risk, zero risk except for inflation and purchasing power, you can buy 10-year U.S. Treasuries. 10 years from now, you will have earned 4.37%. That is guaranteed. On the other hand, you can buy the S&P 500 with an earnings yield, which is the inverse of the price to earnings ratio. It's the earnings to price ratio at 3.7%. So you're getting paid more to own 10-year risk-free U.S. Treasuries. That is unusual. When that happens, you can expect perhaps lower or even negative returns on equities. Now, is this definitive indicator? No indicator is definitive. Earnings can outstrip expectations, and that earnings yield can suddenly look, irrelevant. Yields on treasuries can suddenly come down because maybe the Fed, finally gets control of the inflation situation because they get some help from Congress for a change. The Department of Government Efficiency talking about debt and deficits. All of this is very important stuff. But what it does lead me to believe is that 2025 is going to be a year of transition, of recalibration, and I'm not expecting a recession, a depression. This is not one of those crazy cataclysmic calls, but I do think that we can expect lower returns for equity prices this year or next year. perhaps low single digits. And I think somewhere in the beginning half of the year, we're going to see a correction. Well, why do I say that? Well, let's look at the multiple. Let's look at the earnings, the PE multiple for the S&P 500. Okay, we're at 22.4 times. You can see that on the right. The average since the first quarter of 1990 is more in the 16.5 range. The last time we were at this kind of high level was the end of 1999, which I alluded to earlier. We were a little higher at 22, 25, tomato. The valuation for the stock market is high. When it's high, it's difficult to argue that it can go higher based on an expanding PE multiple. Instead, you have to argue that the earnings are going to grow into that PE multiple and make that PE multiple somewhat irrelevant. And the argument could be made, but we've got the Mag 7. Won't tech, big tech, and the Mag 7 and the move to artificial intelligence, won't that carry the day for us? This is Apple, Microsoft, Google or Alphabet, Tesla, Amazon, Facebook, Meta, and NVIDIA. Well, let's take a look. So far in 2024, these companies have returned 67%. That's more than double the return of the rest of the S&P 500, which would include them. So this is what's driving it. 1 year, 78, 2 year compounded, 1 year, 71, 2 year compounded at 78, and a 5 year compounded annual return of 47%. The laws of math suggest you cannot continue that forever. So it would be, these companies are great. Don't get me wrong. I own them and I'm probably never selling them, but they can't go on this way forever. Math just doesn't work that way. Looking to the right side of my screen, the multiple is 42 on average. The estimated multiple on forward earnings. This is the estimate, analyst estimates. These are the most highly covered companies with the most efficient market for these analyst estimates. 39 times forward earnings. Imagine what happens if we get a setback or a disappointment. 13 times book value not so relevant with tech names, but sales is very relevant, and we're looking at 9 times sales. That's very, very significant. Do they deserve it? Probably. These are the greatest companies in the world today. All I'm suggesting is that it is more likely than not that we do get a 15 to 20% pullback in equity markets this year as we adjust to whatever this final new pro-growth economic reality is. Here's that price to sales ratio again. And I took this back to late 2021, where we were in excess of 8.5 times sales, where you can see we are today. What happened in 2022? Well, look at that. We went from basically 8.5, 9 times sales down to 4 times sales. And the Mag 7 index was down 45% that year. Were the fundamentals bad for these companies? Did it look like they weren't going to make it? They were going bankrupt, they were losing business or market share, or they were ceasing to innovate? No, it was none of those things. It's a simple reality that I expect, first of the year, okay, new clock for capital gains, right? Why would you sell this week when you can wait till January and delay that capital gain payment for another year, tax payment? So it's very likely, in my opinion, only in my opinion, that we get a sell-off in these names sometime in the front half of 2025. One of the things that could be the catalyst for the market recalibrating and resetting is this ultimate realization that we absolutely cannot, as a nation, run perpetual 7% budget deficits. This graph shows the fiscal deficit of the United States going back to the late 1960s. And you can see, if you look at that period from, say, 68 to about 90, or to about 2000, really, you ran an average budget deficit of 2-3%. And we were able to sustain that because of our position as the world's reserve currency. We run trade deficits because all international trade is essentially done, most international trade is essentially done in dollars. Our trading partners have dollars because if we bought stuff from them, they need to put those dollars somewhere, so they buy U.S. Treasury securities. That enables us to run the perpetual fiscal deficit. Really the only country in the world that has this luxury. This results from winning World War II and setting the world financial system in place that we basically still have today. But somewhere after 2000, we began to run bigger and bigger deficits. And the mantra in policy land, whether it was fiscal or monetary, was that when we have what looks like a recession or some other geopolitical problem, let's just run an even bigger deficit. So you see the global financial crisis there. We get to a 10% deficit, which was obscene. But then we followed that up with the COVID and the global economic shutdown, and we ran a 15% deficit. And then you look on the right here and you see these deficits getting bigger and bigger. And now, in a time of peace, relative, in a time of prosperity, a time of plentiful jobs, economic growth, no recession, no major war the U.S. is engaged in directly, we're running a 7% fiscal deficit. That can't happen. Hence the election, hence the results of the election, and now this new Department of Government Efficiency. The formula for GDP is consumption, very strong, plus investment, strong and expected to get stronger, plus government spending. Government spending as a percentage of GDP must go down and should go down. We expect it to go down. And that adjustment alone is going to have an impact in the short term on GDP and then probably a positive long-term impact. That's why I'm not bearish. It's why I'm not calling for a depression or recession, any of those things. Simply a correction in the markets, which is more likely than not to happen in the first 6 months of the year. Now we've got a Fed meeting this week, which we've talked about a couple of times. We've got expected to cut the Fed funds rate down to 4.25% at this meeting. Markets are still expecting continued cuts throughout, as you can see here, with the expected rate through 25 and 2026. But if inflation continues to pick up, as you saw from the PPI report last week and the CPI report last week. Now, interestingly, we're going to get core PCE coming up here. And core PCE, we kind of know where it's going to come in. And it's going to kind of come in better than expected because we know which components of CPI and PPI it uses or emphasizes in its model, which will give the Fed some cover to cut this week. I don't think they should, but they will, and we're going to be dealing with this in stubborn inflation for the first 6 months of next year, on top of the reality of the government spending issue. And of course, the private sector economy will continue to carry the day, but I do expect a revaluation. This graph here shows the components of the CPI, why I think it's stubbornly high. What is that yellow bar? This is services, right? Core services. Services are 85% of the US economy, and core services are not going down. We're just stuck in this high level. This includes rents, right? Residential rent or owner's equivalent rent, these kind of things. Minimum wages, all of this. We've all noticed everywhere we go, everything we look at, prices higher. Food and energy can be volatile, but in core goods, you can see was actually negative last month. It just subtracted from the CPI. But this is the major issue. So let me sort of summarize here the 2025 view. I'm going to start with the economy. Look, I think there's signs of reacceleration. Manufacturing may turn positive. We had a really good number there. That doesn't mean the market actually goes up in the short term. Jobs are plentiful, layoffs are low, the consumer is strong. The problem is inflation. The problem is the deficit. Is the DOGE, Department of Government Efficiency, is it the real deal? Will they come against the entrenched interests of government contracts and government spending and inefficiency? Or will these two gentlemen, Elon Musk and Vivek Ramaswamy, will they be able to make headway? Will they be able to eliminate redundancies and inefficiencies and all of these things? We don't know. And so there's going to be that uncertainty goes into the capital markets in 2025. We know financial conditions are strong, though. We know we're going to get a rate cut this week. Capital is abundant. Capital wants to be invested now, knowing the regulatory regime is getting better. We expect strong tax code incentives for capital expenditures and which hires labor and produces goods and services, etc. And the current estimates for 2.1% real. That's after inflation GDP growth. But then you move over to stocks. Valuations extraordinarily high versus bond yields at over 6,000. The S&P right now, if I look at my Bloomberg terminal, is higher than all but 6 of the analyst estimates for the end of the year, which is now. The estimated earnings per share for 25 is $267 versus the expected for this year, $238. So that's decent growth, 12%. But when you look at the 503 stocks in the S&P 500, only 246 are ranked as buys. There's no sells, of course. The rest are holds, which is sort of the equivalent of, hey, we're not suggesting you buy it. But that number of 246 seems low to me. On the other hand, you've got bonds. When I made this slide the other day, we were at 4.2. We're now at 4.4% on the 10-year Treasury, 438, 439. The other thing is within bonds, the spreads, that is the yield of a corporate bond above a U.S. Treasury, is incredibly low. So you're barely getting paid an additional amount for taking the risk of owning corporate paper. 77 basis points in the investment grade corporate world and 262 basis points in the high yield world. Do I think there's going to be major defaults? No, absolutely not. I think the economy is going to be fine next year. But could those spreads widen out as uncertainty gets into the system? The answer is yes, they can. So what do you do? And this is really important to understand how I manage money for our clients, how Glenn and I manage the money here. We really tend not to preempt markets. We've been around long enough to know that our predictions, if we're really good, we get our predictions right 60% of the time. And so the temptation to preempt this market correction is strong, right? You feel like, oh God, Herb says the market's probably going to go down 15 or 20%. It's a short-term deal. If you're a long-term investor, it doesn't matter. Instead of preempting and trading that correction, I think it's more important to react to that correction. So what's our plan? First of all, we're not going to be overweight equities, right? We're not going to be overweight high yield bonds or, significantly overweight credit. But we're ready. And we could go overweight should we get that correction, because we are positive on the long-term aspects of the economy and the long-term earning aspects of the companies in the stock market. So if you are a financial advisor or investor, I suggest you review your risk profile now. Get ahead of this confusion. Do this at a period of strength. Let's say you came to your financial advisor and then came to us and you were a 70-30 portfolio, but you've been there for 10 years and maybe you're planning to retire in 5 years. Maybe it's time you went down to a 60-40 portfolio. I don't know. But I suggest reviewing client portfolios now to determine. It's always better to review in a period of strength rather than review it during the chaos and the confusion of a market correction. In the very short term, I suggest allowing cash to accumulate, take advantage of that correction when it happens, should it happen, as I predict it will. And it's going to happen within a healthy economy. Use your cash vehicles like T-bills, ultra short bond funds, position traded money markets, etc. Same thing with fixed income is expected. Okay, economic data this week. We've got the PMIs from S&P Global, manufacturing services, the final for December, the preliminaries for December. We're looking at 49.5 today for manufacturing. We're getting close to 50. Services remain strong. Retail sales on Tuesday strong. Production, utilization, inventories, housing, all okay, except for housing is below 50, but getting closer to that line of delineation, especially if we get more rate cuts. If that ever translates into the longer term mortgages, this 10-year Treasury at 4.4 is not helping residential real estate market. Starts and permits on Wednesday. The Fed's rate decision, we're going to get a quarter-point cut. Look to the speech and the after part and what they say and the announcements, so forth. Jobless claims Thursday, looking to come back down to 229. Q3 GDP, Philly Fed, positive. That's manufacturing, so that's good. Expected to go to 2.4. Existing home sales at 4 million. Income spending, core PCE on Friday. This is big. I think it's going to come in as expected at 0.2 because I've looked at the subcomponents of CPI and PPI, and that's sort of going to give the Fed a little cover for what they're likely to do on Wednesday. Then consumer sentiment. Thanks, everybody. Don't forget, any audio podcast player, you can get Slaying Bulls and Bears, making the complex and complicated simple and sensical. But the best place to see us is on YouTube. YouTube, where you get the charts and the graphs. Thanks, everybody. I will not be back to you next week. I will be back to you next year. Thanks for giving me a couple of weeks off. I will be in the office and available, just not doing the commentary for the next 2 weeks. Thanks.